This is Tax Chats. Hello, I'm Scott Dyring.
And I am Jeff Hoops.
And we're here to chat
about taxes.
Hello and welcome again to another edition of Tax Chats. My name is Scott Dyring, professor of accounting at Duke University, and I am joined once again, as always, by Jeff Hoops, my friend and colleague and tax museum curator at the University of North Carolina. Hello, Jeff.
Hello, Scott.
Jeff's super excited to be here today, like always.
I am quite excited, as always.
Well, we're excited today because we're going to talk about the inclusive framework, the OECD, and we're going to try to decide whether just exactly how inclusive it is. It may not be so inclusive. And to help us in our conversation, I came across a very interesting paper by Afton Titus. And so we invited Afton to come on today and talk to us. Hello, Afton.
Hi.
So, Afton, why don't you just tell us a little bit about yourself and we'll jump in.
Sure. So I'm Afton Titus. I'm an associate professor of tax law at the University of Cape Town. I conduct research on tax implications of regionalism in Africa mainly, and I teach undergraduate and postgraduate students on South African and international tax.
Awesome. Thank you. And thank you for joining us all the way from the other side of the world where it's summer, while we here are suffering in North Carolina from something that we don't do well with, snow. So it's great to have you. Let's just maybe start off by getting your take on what the OECD is calling the inclusive framework. And then there's pillar 1 and there's pillar 2. And maybe just give us a little bit of an overview of what that is and how it might affect African countries.
Okay, so pillar 1 is basically the OECD's attempt to tax and address the challenges that it sees coming from the digital economy. So it came up with this idea that it's going to use this particular formula to allocate more taxing rights to what it calls market jurisdictions. And these would be traditionally source countries, and that would include African countries.
So just to be clear, when you say market jurisdictions as source countries, that's basically where the customer is located purchasing whatever it is.
Exactly, yeah. And there are quite large markets situated in Africa. And then pillar 2 is meant to address concerns about tax competition that haven't been adequately addressed by the OECD's BEPS project, so the Base Erosion Profit Shifting Enterprise. And one of the main things about pillar 2 is this idea that there should be a global minimum corporate income tax rate. And just as the name suggests, that means that across the globe, countries should implement a corporate income tax rate of at least 15%. It does have some other technical provisions that tries to deal with avoidance procedures and things that multinationals are engaged in, and try to make it so that multinationals pay tax somewhere in the world.
So they need to pay somewhere, and they need to pay 15%, and the idea is to stop what I think some people call the race to the bottom. Is that correct?
Yes, that's right, yes. Assuming that, that is a bad thing, to have people race to a particular level with corporate income tax, and that also assumes that corporate income tax is important enough to stop that.
So why do you say assuming it's a bad thing? I mean, what argument is there for it not being a bad thing?
So one would argue that it's not necessarily a bad thing if you think about why a country would do that. So ideally, you would think that there would be a rational reason. And for African countries who do decide to lower their corporate income tax rate, it is for a rational reason. The idea is that you're trying to attract an investment partner. So you will lower your corporate income tax rate in exchange for something else. And that something else would typically be significant investment into the African country. So the idea is that this investor would come in and they would set up shop, and then they would hire the African people in the area to come and work there. There would be some transfer of knowledge in that. You would have African people now earning an income where before they might not have. You would have production happening in an African country. You would have all these sorts of transactions that would result in taxable events, not necessarily corporate income tax events, but other tax events. And then you would have benefits coming from that. There could be more explicit benefits, things like investors coming in to build a bridge, for example, and in exchange for that, you give them a lower corporate income tax rate. I think that's all completely rational. If you are going to lower your corporate income tax in order to get a sustainable and identifiable benefit on the other hand, then I would be all for it.
So the OECD's base erosion and profit shifting is based on this idea that it's like bad somehow if companies pay less than 15%. So is the argument that you made sort of more valid or more important for African countries than for other countries around the world? Like why are the OECD countries on board with this, and why are maybe some countries in Africa complaining about it?
Okay, so my understanding would be that for the OECD and countries involved there, they would like this sort of proposal because they don't primarily use tax incentives and corporate income tax incentives to bring about investment into their country. They can compete on non-tax elements. So they have an educated workforce. They have sophisticated financial markets. They have infrastructure that works well. They have, just sometimes it's the mystique of where that country is situated. You could go to somewhere in Europe, for example, and that in and of itself is an enticement for people wanting to work there. It's different for African countries, though, because the reason why they are developing countries is because they don't have those non-tax elements to bring in investment. They may not have the infrastructure, they may not have the educated workforce, etc. So for many of them, what they do have is they have a tax system that they could use to separate and distinguish themselves from the rest of the world. So they could use their corporate income tax rates, which just happens to be very important to developed countries, as we can see from the OECD's volume of papers. And so they use that, and it makes headlines, and it brings in money. It's interesting that you should ask, why is it that African countries specifically would use tax incentives? I mean, that immediately raises the question, does it work? Why do you concern yourself with corporate income tax incentives particularly? And I was so pleased to find this year that there was a study that came out where they looked at 40 African countries and they tried to determine what the impact was of a lower corporate income tax rate with foreign direct investment. And they found categorically that the lower the corporate income tax rate in Africa, the higher the foreign direct investment. So for African countries, corporate income tax rate incentives are not only important, but they work.
Have African countries kind of realized or believed what you're saying, and do they have low tax rates, or what do corporate tax rates actually look like in Africa, in the many countries in Africa?
So for the most part, formal corporate income tax rates are around 25% to 30%, right? So there's a blanket rate. But then according to each country, they decide on which industries are important for its economic development. So then for those particular industries, there would be lower corporate income tax rates, and there would be tax incentives, tax holidays, etc., specifically around corporate income tax, in order to bring in investment in those particular sectors. So typically what you would find then is you would have corporate tax holidays that would be no tax, no corporate income tax paid for periods of at least 5 years. And other places you would have a reduced rate. So it would go from 30% or 25% to 3% for a certain period.
Now, are those holidays common in Africa? I know they're very common in Asian countries. I actually have a paper on tax holidays, and they're extremely common in some Asian countries. Are they common in African countries?
Yes, they are very common, and I'm also happy to say that African countries have learned from the use of these corporate tax holidays over a sustained period. So before there used to be blanket exemptions. So they would just say that you've got, if you're going to work in this particular sector, then you will pay 3% or 0% corporate income tax. And that would be the end of it. So the person investing in Africa would come in and they would tell the relevant minister and ministry that they qualify in terms of what is on the papers at that moment. Often this would happen behind doors, and you can never know what happens then. And then they would have access to this particular exemption. And then that would be the end of it. There would be no further reporting, no further checking of what is actually happening in terms of operations, whether those conditions are still being met, etc. So I'm pleased to say that since a sustained period, but more recently, there have been significant checks put in place in legislation to make sure that these holidays are not abused. So things you would typically find requirements that when an investor qualifies for the holiday, they nonetheless still have to file tax returns as though they had to pay tax. So they could keep track as the revenue authority of how much this tax incentive is actually costing them. And some countries like Uganda have what is called like a tax credit incentive. So it's a tax holiday, but it's up to a certain amount. So you have like a credit account with the Revenue Authority, and you file your tax returns according to how much income you make and how much would be exempted then. And at some point, it would come to an end if you've reached a certain limit.
So these incentives sound like they've been like very valuable for economic development in African countries. And so this so-called inclusive framework by the OECD would, I guess, constrain the ability of countries in Africa to do that or to use those. How would that work? How does the constraint arise through the inclusive framework? Like, what's happening?
So it's interesting because, Africa has 54 countries, right? But there are 26 that actually belong to the inclusive framework. So, that's, just about half. It's not really representative of the entire African continent per se. So
So it's not very inclusive.
No, it isn't. It really isn't. So, they say you join the inclusive framework, but it's really questionable what that membership means. It's very questionable to even try to determine what the purpose is of the inclusive framework altogether, because the OECD, we all know, is there to determine and work for the interests of the developed nations. And then you have the inclusive framework that came about really because there was a serious threat that the rest of the world would just form their own forum without the OECD, and then decide on international tax affairs there. So they came up with the inclusive framework, and they said to everyone who was excluded, please join us, come to this thing we created. And, people go. And then they find out, but often what happens in the inclusive framework is the countries who are there get told that this is the decision that has been made, and we would like you to come on board. That's not very inclusive either. So I think a lot of countries have become disillusioned with the idea of an inclusive framework. And I think that also academic writings have also become much more explicit in the critique of what is happening in the inclusive framework.
Is yours, you're talking about this as if, I don't know how to phrase this, is your opinion, would you say a majority opinion among, for example, tax academics in Africa, or does everybody share this kind of criticism of the inclusive framework?
Let me say this. I have found very few academic papers written by African scholars in favor of what is happening in the inclusive framework.
So at least from what we can read, you're not on an island, so to speak, in terms of your thinking. Yeah.
Yes.
Yeah. So we don't look at this and think of it then as inclusive because many countries don't even have a seat at the table, and maybe because they chose not to. But I am kind of fascinated by what you said, that even when they do have a seat at the table, they're not actually allowed to speak. They're kind of at the table. So, like, why is that? Is that just because the OECD had already decided what they wanted to do, and it was sort of, we're inviting these other countries to make it look good, like for optic reasons? Is that what's happening? Or is it they just don't have enough power to make their voices heard, or what's happening there?
It's all of the above, actually. So, I mean, it is an optics exercise. It does look good to have developing countries on an unelected organization like what the OECD is, trying to make global policy decisions. So, there's the optics thing. There is the other thing is just a capacity concern. So, you would have to have African officials come in to participate, and they would necessarily have to have the needed expertise to relate meaningfully. And if you had that, you would also need to have someone on the receiving end willing to listen, which is not always clear that that is happening. And then things would have to progress in a way that allows for meaningful participation, which is also not clear that that happens. So the speed at which events unfold, the volume of work involved in trying to keep pace with meetings. I mean, just anecdotally, someone suggested that the OECD could probably keep itself funded if it imposed a tax on the number of papers that it generated. I mean, it's insane. So there are concerns about capacity, about how willing the OECD is open to participation, and just the mechanism by which that participation is brought about is all questionable.
So let's suppose that you could, we could like wave a magic wand over the OECD, and suddenly the important players would be completely open to listening and adopting whatever maybe someone like you who's in a developing country or on the continent that has many developing countries, how might you think about changing what the OECD is doing to make it more favorable towards African countries?
So the first thing that I would do, and is to have virtual meetings all the time. Like that's what's happening at the moment. The Inclusive Framework meetings are being held virtually, which I think is fantastic. So that is a huge improvement from what was happening before. People having to take transatlantic flights just to attend a meeting, and how frequently that would have to happen. So aside from the virtual meetings, it would also be a good idea to have pre-meetings to make sure everybody is on the same page, and everybody understands that these are the issues. But more importantly, in those pre-meetings, if the OECD could use its manpower and research ability to say to a particular African country or groups of African countries, because they are all different, if they could group them according to what their economic concerns are, what their economic profiles are. Just, off the top of my head, resource-rich countries versus landlocked countries that don't have rich resources versus coastal countries, for example, they're all different. So if you could have people from the OECD who then study these regional groups and understand what their concerns would be when it comes to what the OECD is proposing. And then as these countries arrive, you would say to them, we recognize what your position is. This is what we think you should be concerned about. How about we have a discussion about this? It's not necessary for everything always to be a group thing, for everything always to be everybody has to agree, a unanimous anything. If you had people and groups who were able to have some sort of commonality, I think you could make some headway that way. The other thing that I've seen in some of my readings about the Inclusive Framework and how it works is that it has been suggested that there be an active mentorship program involved in the Inclusive Framework. So when new members come in, there could be someone who could actually guide them through all of this. And I think that's very useful for anyone, but especially for negotiations at this level. And then people have also suggested, give the people who are there and representing countries, give them some training in negotiation.
Yeah, that's very interesting. So suppose that they did all of these things and they started listening. What aspects of the kind of pillar 1 or pillar 2, maybe mostly pillar 2 with the minimum tax, how would that change, right? Because it seems like the minimum tax is the thing that's really like maybe harming the ability of these African countries to compete on taxes, right? Would you envision like carve-outs that would say if a country is developing in a certain way, then this doesn't apply? Like what types of actual proposals might you envision that could help these countries given their varying situations, as you described?
I would definitely suggest that there be some sort of carve-out, some sort of exemption for countries who are able to motivate. Well, even as I say this, it seems wrong to ask sovereign countries to go to someone, an unelected body, and ask their permission for anything. But in the spirit of the question, the idea then is that you would have African countries who have a clear idea of why the exemption would be necessary. So they say that they want to have a corporate income tax exemption because they want to have economic growth in this particular sector, and this is how they're going to go about it. Everyone is aware about the potential for abuse, and so these measures have been put in place in order to ensure that this tax incentive is going to be effective. And then, of course, naturally, the next question would be, how do you measure success? How do you know it's actually working? Well, then the African country would come forth and say, well, this is what we want. We want X number of citizens employed. We want this amount of expenditure actually being incurred in the country. We want knowledge transfer. You must show us that the persons who are residents of this particular country are involved in decision making, do know what's going on in this country, are able to train others. So, and you could also have objective measures, things like build a bridge or build a hospital or something of that nature. But there would be identifiable measures by which to see that the reason why we have given up corporate income tax is so that we can have an identifiable benefit on the other end. And I think if they are able to do that, then I don't see the point of having a global minimum corporate income tax rate apply to that country. The way I see it, taxes are merely meant to do something, right? You don't collect taxes just because. You collect them so that countries can use that money and do something with it. And the idea is it's going to be for the benefit of all in the country, that a few pay the tax. So then how you measure what is happening is that you have a bridge built. You have people who are now employed. You now have, education opportunities. You now have people that are in a better position than they were because of the tax collected and the money spent by the government. So the way I see it, if tax incentives are structured in such a way in Africa, as some countries in Africa are doing, like Rwanda, then you don't need to collect the tax because the outcome is exactly the same. You have an exemption from corporate income tax in exchange for the investor coming in and helping the government to do everything that they would have done if they had taxes. They build bridges, they give employment, etc. So I don't see what the problem is.
Yeah, so it sounds like what you're saying. When we think about like income shifting, so the BEPS, for our listeners who don't hang out in the tax world all the time, BEPS is base erosion and profit shifting, and I think you mentioned that earlier. Profit shifting kind of can take two forms. One is you move your factory and your people and your actual economic activities to a country with a low tax rate, and then you produce income with those economic activities in the country with low tax rate. And you would say that's fine. There's another.
Not only fine, that's what she wants, right?
That's what we want.
That's what every country wants.
Like, everybody wants that. Who doesn't want that?
Yeah.
Right. And then there's another kind of income shifting, which is I don't actually like build a factory and employ any people and do anything with economic substance. I simply like open an office building with a filing cabinet, and I somehow shift my profits using sort of paper transactions to that country, which allows me to escape taxation without an accompanying economic benefit. And it sounds like from what you said, you're clearly interested in the first type because that's the whole point, is to attract investment and real economic activity. I'm guessing you are opposed to the second type, and that's why there would be these measures created or these performance evaluations to somehow make sure that economic activity is happening. Am I reading am I reading you correctly?
Yes, that's exactly right. So when I speak about tax incentives, that is the idea that I have, that it would be put in place to encourage economic activity, real economic activity. And I also recognize that tax incentives have the potential to, entice other things. You could have tax incentives that would bring about investment, but without the economic activity. And it could be used as a mechanism to hide income, which is bad. I don't think there's anybody who would argue with that. Certainly I wouldn't. So when I argue for an exemption, I am arguing it on the basis for real economic activity. And to the extent that it is evident that these tax incentives are not bringing that about, then I totally agree. Then, impose whatever measures you need to as a global community in order to prevent tax evasion, in order to make sure that people properly declare whatever income it is that they earn. So I am definitely not for tax incentives being used in such a way that it doesn't bring about real economic activity.
Yeah, that's very, very fascinating. Jeff, what do you got left for us? We're running out of time, but you got a chance for one more question.
Yeah, so I mentioned actually that I have this paper on tax holidays, and it's been fascinating to me how relevant that paper is here. I mean, so what that paper does is basically look at countries or companies that have a tax holiday in a company, or in a country, sorry. And it shows that when you have a tax holiday in a country, your company have a tax holiday in a country, that you're more likely to shift income into that country. Not only real income shifting as far as like you build a factory there, but you now allocate more profits to that country. Do you think that could happen? I mean, you're going to have you're going to have this framework where you say, yes, you actually do have to build a factory, but now that you've established economic nexus there, it becomes easier to shift income to this low tax country. Could you see that as a threat to your plan?
It's interesting that you should say that it's a low tax country, right? It's a low corporate income tax country.
Mm-hmm.
So there could be other taxes that are higher than anywhere else in the world. Your VAT could be like, 50% in exchange for that low corporate income tax. So I don't think it's necessarily a bad thing that your corporate income tax rate is low.
But I guess the threat is if you're allocating more corporate income to that country, both now that you have a factory that you can allocate more, that income leaves from somewhere. And so the country that income leaves from is against that, obviously. And that's why they think they need the OECD to protect against that income stripping, that base erosion.
Okay, so I need to make sure that I understand what the question is. So there's a risk then that there is going to be a movement from income that was taxed in a country with a higher corporate income tax rate, and it's now going to move to a country where it's being taxed at a lower corporate income tax rate. And yes, that is a risk. I mean, that's what happens with mobile capital generally. And the idea is that there would be the shifting.
Yeah, I think what Jeff's saying is you could think about it like this. I describe paper shifting and real economic shifting as kind of like two separate things. And Jeff's saying...
They could be correlated.
Yeah, Jeff's saying they kind of go together. They're kind of correlated. If I put my factory someplace...
They don't have to go together, but they could go together.
They could go together. They don't have to, but they could go together. And is that a problem? Like, or maybe it's not a problem. I don't know.
Yes, yes, that is a problem. And I have been thinking about this actually because, in presenting this sort of idea at conferences, people ask you, but where do you draw the line? And the fact is, it's difficult to draw the line. You would need, there are so many different variables that would come into it. I mean, how would you define, at what point does real economic activity actually mean when you talk about IP, for example? I mean, that's just nebulous. As I sit here, I don't know. So that sort of thing would have to, I think it's interesting and it deserves a lot more research. But I do acknowledge that there's a very fine line between what I see as real economic activity and what someone else could argue is actually, to the shifting of paper profits. So I do see that, but for the purposes of, putting this idea into the public space, I think that it's certainly worthy of further research and something to think about. But it is a possibility, but that doesn't necessarily mean that the whole thing is not without merit.
Yeah, very, very interesting. Well, Afton, we have run out of time very quickly here, but it has been very interesting to get your perspective. Really appreciate you taking the time to join us. So thank you very much.
Thank you. This was really so much fun. I really appreciate your time. Thank you so much.
You're welcome. This has been another edition of Tax Chats. I'm Scott Dyring. We hope you'll join us next time. Goodbye.
Goodbye.